Well, hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Uh, Today is Wednesday, February 23rd, 2022. We are in week 7 currently. At the beginning of this week was a holiday on Monday, which is why we're hosting this session today. I had also sent out pre-recorded videos on Monday detailing chapters 13 and 14 a little bit more carefully. So accounting for corporations, which is what we're about to talk about, I have an earlier video on that that I had sent out on Monday, and I'm going to go over this chapter and the next chapter relatively quickly. It's kind of going to be like a Reader's Digest version, if you will. We'll talk about only the important parts, meaning the parts you might see on an exam, I don't know, next week, or parts that I feel like are going to be more important for your career. So that's kind of going to be the approach for today. Is I'll go through the two chapters. It'll be more of like a Reader's Digest type version. Um, Touch bases on what I feel is going to be probably the most important aspects of this, and then we'll be able to talk about those things. So, without further ado, I do want to quickly touch bases on where we are in the classroom. Module 4, Week 7. Oh my goodness, Module 4. Yeah, we've made it to the last module, if you can believe it or not. So, the past 6 weeks have been quite the roller coaster ride, as you know. So, we're almost done, which is fantastic. Um, so we are in Module 4, Week 7. Right now we're talking about Chapter 13. This Sunday night you'll have a Chapter 13 homework assignment that'll be due. And then, of course, we'll also go over Chapter 14 this evening, which has a Chapter 14 quiz. Now remember, there's always two attempts on the homework assignments and the quizzes. So if you're not satisfied with the grade that you've received in the past on a homework assignment or a quiz, make sure you take that the second time. Yeah, definitely you want to do two things. You want to try to understand the content better, and you also want to try to earn the highest score. That's how we do well, right? So so that's where we are in the classroom. I also want to highlight where we're going. So next week we'll have class on Monday, like we normally do. Uh, Again, the reason why we didn't have class this past Monday was because it was a holiday. So this coming Monday, it's not a holiday, so we got class. It's also midterm week next week. So I know midterm week. Oh my goodness, yeah, it's if you could believe it or not, we're already there. So next week on Monday, we'll go over chapters 15 and 16. But next week is very busy. Okay, so my recommendation for success at this point is for chapters 13 and 14, which are due on this Sunday night, try to get those done early and then start exploring chapters 15 and 16 just to kind of get ahead a little bit because next week is very, very busy. Next week we have chapters 15, 16, and the final exam. So that's why it's very, very critical that we are having this class today and that you try to think about what's ahead, right? So look down the road and see what you could do in advance. And we'll talk more about that on Monday, but I just wanted to point that out that we're approaching the end of the course very quickly. So without further ado, let's go ahead and jump into the discussion on corporate accounting. And I'll talk about things like stocks and bonds, which is really what corporate accounting is all about. Um, so again, this will be more of a Reader's Digest type version of the lecture. The videos I had sent out this past Monday, those are more like the detailed lecture points, but I wanted to really kind of reinforce the key concepts for corporate accounting and for the next chapter as well. So let's go ahead and jump on in. So corporate accounting. It's first important to understand what is a corporation. A corporation is its own entity. It acts as its own person. it's kind of they treat it legally. They treat it like it's its own person. That's how they treat the company. The company has its own liabilities. It has its own assets. It basically acts as an individual person. That's how a corporation works. The corporation is an existence which is separate from its owners. It has its own rights and responsibilities. Corporations can be held either privately or publicly. Now, here's the difference. A private corporation means that an average investor like myself, I can't go buying stock in a corporation that is private. Like if I say, oh, I really like Sears stock, but Sears now, as you know, is went to being public to private. So I can't purchase Sears stock because it's a private company. So private means that it's a privately held company means that it's private, meaning the average person cannot buy shares of stock in that company. It's not available to the public. It's only available to private investors. Publicly held corporations are publicly traded, meaning you can go onto a stock brokerage account like TD Ameritrade or whatever, right? One of those uh, stock brokerage accounts, or you can even just buy it right on the market. You go to like uh, uh, Dow Jones Industrial, or you go to S&P 500, or wherever, and you can buy stock, right? That's what it means to be publicly held. It's held for the public's interest. So publicly traded companies are very well known companies that you know um, that have stock that you can purchase publicly, right? Anyone can buy the stock. That's what it means to be publicly held. An example of that would be Starbucks. You can buy shares of Starbucks. Another example would be uh, Macy's. You can buy shares of Macy's. There's so many different examples of those large companies that have shares available that anyone can buy. That's what it means to be publicly held. So private means the average investors cannot buy the stock. It's only through investments. It's very small groups of people. Publicly held companies, anyone can buy the shares of stock. So the reason why corporations exist is there's advantages and disadvantages. Like I said before, a corporation is treated as its own person, so it's a separate legal entity. It has limited liability, easy to transfer ownership rights. It has continuous life, no mutual agency, and it's easy to accumulate capital. Now, the one of the key things on that list that I had just mentioned is this one called continuous life. What that means is even after the founders of the company pass away or they retire, the company continues forward. So it's kind of like Macy's, for example. The founder of Macy's was founded in the mid to late 1800s. Okay, so the founders of Macy's, they passed away a long time ago, but Macy's is still around and it's still publicly traded. So that's just one example of a company having continuous life. It's its own entity. It lives as its own person, basically. So that's one of the major advantages of a corporation. Disadvantages are things like government regulations and corporate taxes. Well, of course, government regulation imposes certain restrictions on what the companies can and cannot do, right? It's like, oh, you can't sell that product because there are other companies that sell that product, right? Like an example would be a monopoly. In a monopoly situation, you have companies that control certain jurisdictions. An example of that would be Pepco. Pepco is the only electric company for the District of Columbia. So the government regulates Pepco. They cannot do certain things. So that can be seen as a disadvantage for the company. Another disadvantage for a company like Pepco would be corporate taxation. So companies get taxed based off of their income, their revenue, and especially off their net income. That's where corporations in the United States primarily receive taxation. And so the more net income that the company generates, the higher that they have to pay, the more they have to pay in taxes. And so that could be seen as a disadvantage because the funds that they pay in taxes could actually go toward investing back into the company, expanding the company. Most corporate structures are organized in such a way, we call this a top-down approach. You may have remembered this from your intro to business course. So most corporations have a top-down approach. The stockholders, uh, they tell what the board of directors what to do. A lot of people think, oh, the board of directors is in charge of the company. No, they're not. The stockholders are in charge of the company because the stockholders elect the people that sit on the board of directors. Oftentimes, with stock, some stock has what they call voting rights, and those voting rights are used to vote for the people that sit on the board of directors. The board of directors oftentimes includes a couple of corporate officers like the president, but there's also a lot of oversight on the board of directors. The board of directors tells the company officers what to do. And of course, the company officers, like the president, vice president, and other officers, they tell the employees how to operate the company. This is a very typical corporate governance structure. Now, earlier I had said that some stockholders have this thing called voting rights. They vote for the people that sit on the board of directors. That is their vote, right? Uh, Stockholders, not all, but most, have the voting rights. The preferred stockholders and the um, common stockholders, these are the two different types of groups of stockholders. We have preferred and common. The preferred stockholders typically do not have voting rights. The common stockholders do, typically. That's not always the case, but that is typically the case. Stockholders have the right to buy and sell stock as they see necessary of any company. They might receive dividends. Dividends are kind of like it's kind of like a interest. It's kind of like an interest. When you hold stock, you might receive what they call a dividend. And a dividend payment is simply a, a thank you for holding stock in my company, or a form of interest of the stock that you hold in my company. That is a dividend. We'll talk more about dividends here shortly. The one of the other rights that stockholders commonly have is they share in the assets, meaning when a company goes out of business, a corporation goes out of business, or getting ready to shut down. Sears, for example. Yes, I'll use the example of Sears. So when Sears decided, hey, you know what, we're no longer going to be a corporation. We're going to start selling off a lot of our assets, closing a lot of our stores. In that process, what happens is first the creditors get paid through a liquidation. The liquidation is I'm going to sell my inventory below cost or a very reduced price. And so from that liquidation inventory, Sears paid back their creditors. Anything that was left after the creditors got paid, any remaining stockholders would receive some of those assets. Those are all the rights that stockholders have. Now, this is a little old because don't think, I think some companies might still do it, believe it or not. but these days it's all digital. Stock certificates. When you buy a stock in a company through one of the exchanges or through like a brokerage account like TD Ameritrade or Robinhood or whatever you like, right? When you buy a share of stock, you receive this thing called a stock certificate. It represents each share of ownership. It'll say uh, how many shares it is uh, and what the value is. And so this is kind of like almost like a title to a car or to a house, and because it's a share of ownership. And on the back, you would endorse it anytime it gets sold or transferred. These days, a lot of companies it's more digital than anything else. I don't know if a lot of companies still issue the paper ones. And I remember getting one of these a long time ago from Starbucks, and they're really thick. It's like it's almost like a printed on cardboard, pretty much. It's like a really thick paper. It's interesting. It's a certificate of stock. So I briefly talked about the two different types of stock. One of them is called preferred stock. The other one called common stock. There's a couple of other forms of stock, such like treasury stock, and it, those are like the types of stock, the categories: preferred stock, common stock, treasury stock. I'm going to talk about the details of stock when they're authorized, issued, and how many shares of stock are outstanding. So what happens when a company is first formed is they decide on the number of shares that they're going to issue to the public. Say, okay, you know what, or I'm sorry, authorize. The number of shares we're going to authorize. Authorization of shares means, hey, you know what, our company, when we first formed it, it's worth this much. We are interested in getting the public to invest through shares of stock. So we'll authorize to sell a certain number of shares. That's what happens when the company is first formed. It's written in the company's charter. And this example, this brand new company decided, hey, you know what, we're going to start off with 250 million shares of stock valued at about a penny a piece, right? This is how, and this is very common. So, like, if you ever look at a company's financial statements, it'll say par value 1 cent. What that means is the company set up each share of stock, it had to be worth something. It can't be worth nothing when you first set up a corporation. The shares of stock must be worth something. So a lot of times companies will select 1 penny as the par value, meaning it'll never go below 1 penny. Right? It'll at least be worth a penny, but it's usually worth more because of the value that flows into each share of stock as time passes. So when the company first sets up, they'll authorize a certain number of shares of stock with a par value of a penny each. The company will decide to issue stock. When a company issues stock, that means that they're issuing it to the public. It's available for sale. It's available for sale. And so when a certain number of stock will be available for sale, and a certain amount of stock will be what they call outstanding. The word outstanding means it's the number of shares that are currently out of the company's possession. They're with the company, or with the shareholders. Outstanding means it's the shares outstanding. They're out of the company. They are that's the number of shares that are currently held by stockholders. That's what outstanding means. So earlier I mentioned that a stock must be worth something when it's authorized. Typically, it's worth about 1 penny. That's that is an arbitrary number that is decided by the company when they create shares of stock. So when they issue or authorize a share of stock, it has what they call a par value. It's an assigned arbitrary amount to that stock. So 1 penny, which is actually the most common 1 penny value for each share that is authorized, meaning created. It is not the same as the market price. So when you see, oh, par value 1 penny, that means it's worth 1 penny. No, no, no. The share of stock is not worth 1 penny. That's the value of the stock. Value of the stock is 1 penny. The, what it's actually worth, which is the market price, that's typically much higher. So it might say par value 1 penny for a share of Starbucks stock, but right now, if you go to the stock exchange to purchase a share of Starbucks stock, it'll be $150. So that's what we mean by the par value is not the same as the market price. The market price is what you'll see that the share is worth on the stock exchange. So you go to the Dow Jones or the S&P 500, and you're like, oh, I wonder what the value of Starbucks stock is today. That's called the market price. That's what it's worth today. That's in the open market. It's what it's available for sale in the open market. And that's not the same as par value. Par value is simply an arbitrary amount when the stock was first created. It's usually 1 penny. So there's different types of classes of stock. There's par value, which we just talked about, which is an arbitrary amount. There's non-par value, and then there's the stated value. And we'll talk about those. Okay. When a company is first created, any company, I don't care if it's public, private, small, large, whatever. When you first create a company, let's say that Zach is interested in selling cars. We'll say, or oh no, better yet, Zach wants to open his own bar. Now we know Zach's a bartender, so Zach wants to open his own bar. We'll say, for example, just example, Zach. I mean, I'm not saying that you're going to do this, but I'm just saying this is an example, okay? So let's say Zach is like, you know what? I've had enough working for everyone else. I'm gonna open my own bar. So when Zach does that, he decides to either create a corporation that owns the bar or an LLC or whatever, right? And so he goes, well, I need to set it up. When Zach goes to set up his bar, what he's going to do is he's going to get some assets. He's going to find a building. He's going to find all the equipment, all the furniture, etc. And he needs to get that allocated into the business. And Zach's going to get something out of it. Okay. uh, through what we call owner's equity. We remember that conversation. We had that conversation, I think it was last week or the week before. We talked about owner's equity. We talked about basically the value of what the owner brought into the company. And so let's say Zach also says, hey, you know what? I also am going to bring some cash and other assets into the business. So when Zach does that, he brings cash and other assets into the business, like furniture, and he's putting some cash in to get it up and running. We call that paid in capital. That's a paid in capital account. It is an equity account that is set up to represent the cash and other assets that Zach brought into the business. What does Zach get out of that transaction is he receives stock that represents the value of everything he brought into the business. So that's called paid in capital. Another form of equity that shareholders get is called retained earnings. Retained earnings is also the fourth financial statement. Now remember, in accounting we have four primary financial statements. We have the income statement, the balance sheet, the statement of cash flows, and the fourth one is called statement of retained earnings. The statement of retained earnings is it represents the net income from the end of each accounting period minus any distributions. Distributions are known as dividends or an owner's withdrawal. So retained earnings is what is retained in the business. That's why we call it retained earnings. It's held in the business at the end of the accounting period. So at the end of the month, let's go to Zach's bar business here. So at the end of the month, Zach goes, I did pretty well this month. I got a net income of 50,000. I would like to pay myself a dividend or owner's withdrawal. So when he does that, he'll take that amount out of retained earnings and of course out of cash, right? So so instead of leaving that money in the company, he says, hey, I'm going to pay myself. Okay, great. So that's how that works. Sometimes owners of companies, they don't have a paycheck. They don't pay themselves regularly. So what they'll do is they'll have an owner's withdrawal from the retained earnings. Now, it works the same way with dividends. So when a corporation goes to pay employees, to pay their investors, their stockholders, a dividend, they'll take that out of retained earnings. Yes, Zach, please.
Just a quick question. Do you have to, can you pay yourself a salary if you're the owner and major shareholder? You're allowed to do that as well?
Yeah, and you should. Obviously you got to pay yourself to survive, right? So yeah, that's very typical, and that's why I brought that example up, because owners of a company, let's say you have a small business, okay, and you want to pay yourself. Well, yeah, of course, you want to pay yourself. You have to live, right? You got to pay rent, you got to pay living expenses, right? So yeah, pay yourself. And oftentimes, there's two ways to do that. Number one is you can be an employee of your own company and pay yourself a salary. The other way of doing that is to do what we call owner's withdrawals through retained earnings. And those are pretty much the two ways that owners pay themselves. Great question. So let's talk more about the stock thing. So companies, as I had said earlier, issue shares of stock to receive investment. Okay, so let's think of like any company, for example. Companies need cash to run the business. Where do you think they get that cash from? It's not just from sales. If it was just from sales, these companies wouldn't be anywhere near as big as they are today. So what they do is they issue shares of stock. Now, we talked about how the stock is created. At the time the company is created, they have what's called a company charter. In the company charter, it tells you how many shares the company is creating, authorizing. And the company will sell shares of stock on the stock exchange. When they do that, they're raising cash, because when you go on the stock exchange and you buy shares of stock, you're paying, right? You're buying shares of stock. Here's some cash, give me the stock. That's how that works, right? And so when you're buying shares of stock from the company's cash is going up, and their equity is, technically doing the opposite, right? Because remember, assets equals liabilities plus equity. That needs to always be in balance. If cash is going up, something else must be happening to the equity account or to the liabilities. So here's an example of when a company issues some stock. A new company, snowboard company, decides to issue 30,000 shares of stock at $10 par value for 300 grand. 30,000 times 10 is 300,000. So let's record the transaction. We debit cash. Why? Because we're selling stock. We're selling 30,000 shares at $10 a piece. That's 300,000. So we debit cash to increase our cash by 30,000. We credit common stock 300,000. Remember, you can't just get cash for no reason. So in this case, we're selling shares of stock, which is equity. I increased my cash by 300,000. I also increased my common stock account by 300,000 to represent the issuance of each share of stock. Sorry, did I go too fast? In this example, our snowboard company issues the 30,000 shares at $10 per stock value at $12 per share. Okay, remember the key terms here. Par value. Remember we had said earlier on that par value is an arbitrary amount that the company says that their stock is worth at the time the company is formed through the charter. Okay? So the issued amount is par value, it's $10 per share. The difference is the market value. The share is worth $12. Par value is 10. So we need to show the difference. The difference obviously is $2 per share, but that difference is what we called paid in capital in excess. In excess, meaning the company is essentially retaining an additional amount over the par value. Because each share of stock is worth $12 on the market, it has a par value of 10. It's worth 12. So they sell it for $12 per share. But we still have to book it based on its par value. So here's how that works. We debit cash, because we're receiving cash, $360,000. Why 360? We sold it for $12 per share on the market. So record the market value, $12 per share, times the 30,000 shares issued, 360,000. Then we credit common stock par value. Remember, par value is the arbitrary amount that we said that each share is worth when we first set up the company, par value. We have to recognize par value, and then we recognize the difference. So par value is $10 per share. So $10 per share times the 30,000 shares, 300,000. We credit 300,000. Then we credit the difference. The difference is $2 per share. The price per share on the market, $12, minus $10 par value. That's $2 per share. Okay. So $2 per share is the excess. So I go $2 times 30,000 shares, that's 60,000. That's my difference. It's kind of like, remember when we talked about fixed assets? And if I sold a fixed asset, I have to represent the loss or gain. It works the same way. It works the same way. So our company, we issued 30,000 shares. We had a par value of $10 per share. We authorized 50,000. We issued 30,000. So we have a difference. On our stockholders equity report, or retained earnings, our stockholders equity on the balance sheet. You know that bottom part of the balance sheet, right? Or the bottom right says stockholders equity or equity, owner's equity. In that area, you'll typically see common stock, preferred stock, treasury stock. You'll see paid-in capitals. You'll see uh, the owner stuff, right? Because remember, well, a few weeks ago when we first started this class, we had said that assets are what the company owns. Liabilities is what the company owes. And equity is what the owners own, right? So that's how this the equity comes into play. And you could think of stockholders as being owners, essentially, of the company. They own shares of the company. That's what it means to own shares of stock, right? You own a share of the company. Okay, uh, so on your stockholders equity report, it looks like this. We issued 30,000 shares, $10 par value, 300,000. We sold 30,000 shares at $12 per share. So that means we have an excess, paid-in capital in excess of par, 60,000. Then we add our retained earnings. Remember, retained earnings is what's left in the company after any type of owner's withdrawals or dividends are paid out at the end of the year or into the accounting period. That will equal your total stockholders' equity. So it's the common stock at par value that has been issued, plus paid-in capital in excess of par, plus retained earnings, equals total stockholders' equity. It's kind of like the formula to find total stockholders' equity. We talked about par value. Remember, par value is an arbitrary amount that the company said that each share is worth when the company was created. It's in this charter of the company. Now we need to talk about this thing called non-par value. Non-par means there is no par. Okay, it means there's no par value. That's what it means. And this is somewhat common as well. A company might issue non-par value uh, to certain shareholders, we'll say. Um, it's not as common as you think. It's non-par value is just not as common, but it's something to talk about, right? So our snowboard company, decided to issue 1,000 shares of non-par value stock at $40 per share. When it's non-par value, it's real simple. Because there's no par, we just simply multiply the amount of shares issued times the share price. So in this case, 40,000. We debit cash 40,000 to increase our cash by 40,000. Remember, we're selling shares of stock here. And we credit common stock non-par value, 40,000. So those types of transactions are very straightforward. They're also somewhat not as common. But similarly, not the same, but similar, I could sell non-par value shares of stock above or below a stated value. A stated value is kind of like saying par in a way. It's kind of like par value. But because there is no par value on this type of stock, we could have what's called a stated value. A stated value is simply a number that the company says that share of stock is worth. And that is typically measured by the company's assets. It's kind of like saying, this is how much my company's worth, right? It's real value, it's true value, stated value. That's how we find stated. It's kind of like the real value of the company. So in this example, we issued 1,000 shares of stock. The stated value is $40 per share. We sold it for $50 per share. Okay, so that's good. We sold it in excess. And so it works very similarly to par value. It works very similar. It's just the difference is the type of value that the stock holds. Par value, as we said, is an arbitrary amount that the company decided when it was formed. The stated value is what the company's worth, right? But based off of the assets. And so in this example, we debit cash 50,000 because we sold 1,000 shares at $50 per share. We credit common stock $40 stated value. That's going to be 40,000, of course, because it's stated value times the number of shares issued. 40 times 1,000. And then we're also going to credit paid-in capital in excess of the stated value for common stock. In this case, of course, is 10,000. How do we get 10,000? We take the price per share that we sold it at minus the stated value per share. So 50 minus 40 is 10. 10 times 1,000 is 10,000. That's how we got there. This one's interesting. Issuing stock for non-cash assets. So my earlier example with Zach said, "Hey, you know what? I'm tired of working for other people. I'm going to open my own bar." That's what Zach said. So let's say Zach decides to do that, and he's going to build his own bar, and it's going to be a corporation. All right, cool, very cool. So what he needs to do is he needs to buy some land, but instead of Zach just buying the land, he made a deal with the landholder, the landowner, said, "Hey, you know what? Instead of me paying you in cash, I'll pay you in stock, in common stock." Okay, great. That sounds like a nice exchange, right? Instead of paying cash, I'll pay you in stock. Okay, cool. That's common. That's very common. So let's say you find a small business and you're looking to invest in that small business. Instead of cash, there might be an exchange for stock, for the asset, right? So in this example, we are buying a piece of land, but instead of paying in cash, we're going to pay in stock. It's somewhat common. It's not probably as common as you might think, but it does happen from time to time. So in this example, we purchased a piece of land valued at $105,000. And we did that for 4,000 shares of stock with a $20 par value. Okay, obviously 4,000 times 20 is not 105, it's 80. So there's a difference. So that difference is what we paid in excess of the par value. So I debit land, 105,000. So that's how much it's worth. I credit common stock par value, 80,000. 80,000, how? Par value times number of shares. The difference is what we call paid in capital in excess of the par value. In this example, 25,000. And you can always find that difference, right? Just taking the value of the land minus the common stock at par value. Here's another example. This is probably a little bit more common with smaller businesses as well. Let's say we had some expenses to get the business up and running, okay? And oh, this is a great example. So let's say Zach decides to open a bar, and instead of paying for some of his organization expenses to get it up and running, like instead of paying the lawyer, instead of paying the accountant, instead of paying the promoters, he decided to issue them shares of stock in his bar. A great idea, brilliant. It saves the company from having to pay out cash. So I'll give you some shares of stock instead. Brilliant, brilliant thought. So what he did is he amassed at $12,000 worth of organizational expenses. From the attorneys, from the accountants, from everyone else, okay, from the promoters, and so he debits organization expense 12,000 to recognize the expense. And instead of paying for that in cash, he paid those individuals using shares of stock with a par value of $15 per share. And so he gave them 600 shares. Hopefully he did that equally. So he gave them 600 shares. So it's $15 per share, the par value, times the 600 shares. Well, that's 9,000. 15 times 600, that's 9,000. So there's 9,000. Obviously, there's a difference. The expenses were 12, but you gave them $9,000 worth of stock. So the difference is what we call paid in capital in excess of par value. To find the difference, we just take the amount of the expense minus the common stock at par value. So it happens, yeah, it sure does, but it's not probably not as common. But sometimes you work a deal. It's all about the deal. If Zach says, "Hey, instead of giving you cash, I'll give you stock," yeah, do that deal all day long. And then ultimately, if you decide, if it's because the reason why that helps, why would somebody want to do that? You might ask. It's like, oh, why would somebody want to have stock instead of the cash? Well, it's simple, really, because over time, Zach's going to pay out dividends to the stockholders. And so, yeah, it's kind of like, hey, Zach, instead of paying me back, just pay me in dividends over time. That's nice, right? So a couple times a year, the board of directors gets together and they decide on when to issue cash dividends to the stockholders. Usually 4 times a year. Sometimes less, sometimes more, sometimes way less. It depends on the company's charter. So in this example, uh, you know, our company pays dividends, and we pay that on a pretty regular basis. And what that does is it incentivizes other people to purchase the company's stock, which is obviously great for us, right? More cash coming in. And it also provides a sense of investment for the stockholder, right? Because hey, I'm receiving a dividend. That's kind of cool. So that's a concept behind cash dividends. Uh, Obviously, the company's not going to pay a dividend if they don't have enough cash on hand to do so. And they also need to make sure that they have enough in the retained earnings balance to be able to pay a cash dividend. If I don't have retained earnings, meaning I haven't left enough income in the company, retained it in the company, I'm not going to pay a cash dividend. It's real simple. So cash dividends, when the company decides to do a cash dividend, we call it a date of declaration. That's when we decided, hey, yes, we're going to pay dividends. Great. Uh, the date of record, when the company decided to pay the dividend, that's the date of record. And the date of payment is obviously when the company decided to pay the stockholders with the dividend. Payment. Those are the dates. They're very important for issuing dividends. So here's a nice example. We have a company that issues $1 per share cash dividend. Nice. We have 5,000 of common shares of stock outstanding. Okay, so it means looks like I'm going to be paying 5,000 bucks. The dividend will be paid on February 1 to the stockholders of record on January 22. So in other words, whoever's still a stockholder on January 22nd, they will receive $1 cash dividend for each share of stock that they have. And they'll receive that payment on February 1. So there's a couple of transactions that I need to record. The first one is to record the liability for the dividend. On January 9th, our company said, yes, we said, yes, we're going to pay a dividend. Great. So January 9th is the date. I debit retained earnings to reduce the retained earnings. And I credit common dividend payable, common stock dividend payable, to represent the new liability that I got to pay my stockholders. And then on January 22nd, I identify who's still on my roster, who still owns the stock. There's no entry required for that, but it's just important to know the dates. But on February 1, I'm paying my dividends. So I debit common dividends payable to reduce my liability, and I credit cash to reduce my cash. These are the types of transactions that we would make to show when we decided what happens when we decided to pay the dividend, and of course when we paid. Oh, this part's always painful. Sometimes a deficit. Deficits are bad. A deficit in cash dividends. Deficits happen when there's cumulative losses. Sometimes our business might have a few bad months where we just, it's been rough. Okay, my sales are down, having a rough time, for whatever reason. So sometimes creates what we call a deficit. So I won't be able to pay. Typically, I'll either pay out a reduced dividend amount or no dividend at all. And that might happen for a couple of years. That happened a couple of years back with General Electric, as an example of a company that happened to recently. And so company had a deficit. They couldn't pay out the dividend for a couple of years. That's normal. That happens. The company just doesn't have enough cash on reserves through retained earnings. So when something like that happens, we have to reduce the amount of what's paid out. So if the retained earnings is a negative amount, we subtract that from whatever we have in stockholders' equity, or we bring that stockholders' equity down to its new value. I don't like deficits. Deficits are bad. It means you ain't making money. Okay. So instead of paying out cash dividends, sometimes a company might decide to issue more stock to those stockholders. We call that a stock dividend. So instead of paying out cash, through the dividends, they might say, hey, you know what, you've been a nice stockholder. I'll give you some more stock. Yep, that's nice. It's again, it's a very nice benefit to the stockholder because now all of a sudden they have some more stock instead of a cash dividend. That provides confidence in the company. Usually says the company's doing well. And the good news is that over time, that means that that stockholder who had one stock before now has two, or one and a half, or whatever, and that usually means that they'll receive a larger dividend in the future because now they have more than one share. Because dividends are paid out based on each share. That's kind of cool, right? So of course, there's some recording that needs to happen when a company decides to issue a stock dividend instead of a cash dividend. So when a company decides to issue a stock dividend, they debit retained earnings, credit common stock dividend distributable, common stock dividend distributable. Okay, cool. Uh, and then they'll credit if it's in excess or if it's in loss with the capacity. But this is an example of what that looks like. Nice example, and this is the effect, of course, on the stockholders' equity. And just as before, just like with the cash dividend, there's a couple dates. There's a date of distribution, there's a date of declaration, date of distribution. So those dates come in handy, and we have to do pretty much the same type of recording that we would as we did with the cash dividends. The difference here is that instead of cash, of course, it's common stock and then at par value. Uh, and a lot of it has to do with the size is what makes the amount, right? So it's the number of shares uh, times the percentage of the share that's being issued through a dividend. That's how we find the number of shares being issued. Stock splits. This one's fun. So one time I had when I had shares of Starbucks stock. One time they had what's called a stock split. Stock split's nice because instead of having one share of stock, now you have two. They split that original share in half. That's what they call stock split. They split as share of stock into two instead of into one. It's still worth the same amount. It's just the number of shares is what changes. So, for example, if I have one share of common stock of Starbucks stock, and it's worth $20, and Starbucks says, "Hey, we're going to do a stock split." So instead of that one share of stock at $20, now I have two shares of stock worth $10 each. Now, why is that good? You might be asking. Oh, all you're doing is splitting them in half. It's still the same amount. Yeah, you're right. But the difference here is that instead of that one share, I got two. So what happens over time is the value of the stock increases, and now I have two that are worth, more over time. So that's why it's a benefit when that happens. And of course it attracts new investment. That's one of the other benefits behind it. Characteristics, yeah, we'll talk briefly about this. Preferred stock. So we talked a lot about common stock. Common stock is the reason why they call it common stock is because it's commonly available. It's common. It's that's why they call it common stock. Another type of stock is called preferred stock. Preferred stock uh, is treated a little differently. with respect to distributions of dividends and assets in case of liquidation. Most, and this is in most cases, preferred stock is held by employees of the company, the board of directors, uh, the CEOs. Those are the kinds of people that hold preferred stock. Those shares of stock do not have voting rights. Only the common shares do. Preferred stock does not have voting rights, and they usually have a stated dividend rate. So sometimes in the news you'll see, oh, this certain CEO sold a bunch of stock, they got a bunch of money. That's why. That's why that happens. Is because oftentimes those CEOs will receive like a compensation package when they're first hired. It's like, oh, here's 10,000 shares of preferred stock. Okay, great. Yeah, it is great, especially when you sell it. It's a lot of cash. So that's why you hear sometimes you'll hear those types of stories. Preferred stock can either be cumulative or non-cumulative. Now here's what this means. Cumulative means that it builds up over time. Non-cumulative means it doesn't, right? Cumulative meaning it can be paid out in future years rather than being paid out regularly, which is non-cumulative. So I can hang on to my preferred stock over longer periods of time, and the longer I hang on to it, typically the more it's worth. And then I can have it paid out later on. Again, that goes back to my story about the CEOs and how, oh, they were CEO for 5 years and they got several millions of dollars to leave the company. All they did is they sold their preferred stock back to the company. And that's why they received those large amounts. That's a nice example. Again, this is the Reader's Digest version. I'm only highlighting the important stuff for this chapter and for the next one, at least for today's lecture, because I did release the full lecture videos this past Monday. So if you want to go back and elaborate a little bit more, you're more than welcome to do so. But I felt like our time is valuable, so I want to make sure that I tell you the important stuff. Uh, you don't need to know about this. It's nice to know. It's not that important. Treasury stock. Okay, I do want you to know about this. This is important. Sometimes a company might repurchase their outstanding stock. Repurchase their outstanding stock. Sometimes a company might repurchase their outstanding stock. That's called treasury stock when that happens. What happens is that companies like to influence the market price of their stock. The way they do that is through treasury stock. What happens is that when there's less shares of stock available, outstanding, in the market, the remaining shares that are outstanding increase in value. When there's less of something, the value of whatever is remaining goes up. That's called treasury stock. That's what it's all about. So companies, what they'll do is they'll say, oh, we're going to do a stock buyback program. So they'll approach current stockholders, say, hey, we'll buy the stock back. And so what they're doing is they're creating treasury stock within the company, which are the shares that they bought back from the stockholders. And what that does is it raises the value of that share of stock that's outstanding. So now, instead of you buying that share of stock for $20, now it's $35 because there's less of it available. An example of a transaction, an example of that is if the company decided to repurchase shares of its own stock on the open market. So we debit treasury stock and we credit cash. Obviously, the company's paying cash and they're bringing back in their own stock. So instead of it just going back to common stock, the company now owns those shares for themselves. So we call that treasury stock. And sometimes later on, the company might decide, hey, you know what? We need more cash. So what I'm going to do is I'm going to sell the treasury stock that we had repurchased earlier from our shareholders. I'm going to sell that again. And so, yeah, that's common. So they'll debit cash, credit treasury stock. A couple of examples of companies that do that. I know some of you are hospitality majors, so you'll probably like this. Um, Choice Hotels, they operate a lot of the big brands like uh, Holiday Inn, um, Choice, a couple of other properties, yeah. And they're notorious for engaging in treasury stock programs, stock repurchase programs. Marriott does that once in a while too, but it's Choice is like very well known for doing it. Which is why sometimes you're like, why is Choice Hotels stock that high? Oh, they engage a lot in treasury stock repurchase programs. Uh, Sometimes the company might sell their treasury stock above what they paid for it. Great, cool. All right, so that happens. Debit cash, and then they credit the treasury stock, and then they credit paid in capital treasury stock to represent the difference. That's nice. So yeah, it's nice to sell it for what it's worth. Sometimes a company might decide to sell their treasury stock below what they repurchased it at. Yeah, that happens from time to time too. And again, so a lot of the times these decisions are based off of the company's need for cash. So in this example, we debit cash, debit paid in capital treasury stock, retained earnings, and we credit treasury stock. And the reason for this is when you when it's below value, it's a debit, not a credit. It's kind of representing the loss, if you will. On that statement of retained earnings we talked about, because remember, there's four primary financial statements. There's the income statement, balance sheet, statement of cash flows, and the fourth is called the statement of retained earnings. Statement of retained earnings is going to show you the amount that is retained in the business. That comes from net income. So we have net income, which turns into retained earnings if it's left in the business. So net income, for the first year, it's net income minus dividends or minus owner's withdrawals or minus whatever equals retained earnings. And that's very normal retained earnings for the first year. For the second year, it might be retained earnings plus net income minus uh, dividends minus owner's withdrawals equals retained earnings. Also break. And here's a nice example of a statement of retained earnings. I do like this one. So we have beginning balance retained earnings from the previous report. Uh, Looks like the company got some land that was expensed incorrectly, so adjustment for $200. Plus net income minus cash dividends equals ending balance retained earnings. Uh, yeah, that just kind of shows you the change. Then this report right here which is statement of stockholders' equity, which shows you the changes of stockholders' equity that happened throughout the accounting period. Couple ratios. You know, we can't get through a single chapter in this course without at least a ratio or two. This one's called earnings per share. Earnings per share is used to kind of get an idea of how much each share of stock is worth with respect to buying power. So it's net income minus preferred dividends divided by weighted average of common shares outstanding. You don't have to go too deep into it. It's not something we're going to get too excited about in this course. Another one's called price earnings ratio. This one tells us what the projections are for future growth of the company. This one's kind of exciting if you're interested in figuring out how much the company is going to be worth in the future. For those of you who are interested in finance, this is a very common finance ratio. We take the market value per share divided by earnings per share. Another one. This one's called dividend yield. I like this one because it shows annual cash dividends that are projected in the future, called dividend yield. We take the annual cash dividends per share divided by the market value per share. Gives you an idea of how much each dividend is going to be. This is the last one. This one's called book value per common share. Book value refers to the value that it's worth. Value that's worth. Call that book value. Book value. What it's worth is usually different from what is the market value, what is the stated value, and what is the book value. Market value is how much the market says it's worth. The stated value is how much the company says it's worth. The book value is what it's actually worth. that's how I view it. Just take stockholders' equity for common shares divided by the number of common shares outstanding. That, my friends, is the end of our discussion for accounting for corporations. I'm going to quickly stop the recording and start the next one for chapter 14. And we're going to get through this next one in 15 minutes. Hold on just a second.